All right, looks like we are live. So good evening. Thank you so much for joining me for this, the February 8th edition of Office Hours. My name is Dr. Tisa Silver Kennedy, and I'm the founder and director of the Maryland Center for Collegiate Financial Wellness. So before we get into questions from our community, I just wanted to tell you a little bit about the center, then a bit more specifically about office hours, and then we'll go straight to the questions that we've heard since our last edition of Office Hours in January. So the Maryland Center for Collegiate Financial Wellness was founded in 2021, and we are helping students and families build their financial life skills and empowering them to thrive. Our vision is quite ambitious, and that's that all college and career school students in the state of Maryland are able to achieve these 6 pillars of collegiate financial wellness. They are being creditworthy, ready, resilient, empowered, successful, and thriving. I'm not going to go through the details of all of those pillars with you, but if you are interested in learning more about the center and how we are working to achieve this vision, you can visit us online at mccfw.org. Again, that's mccfw.org. One of our original programs, Office Hours, has been happening since December of 2021. This is our free semi-monthly virtual student loan clinic that provides borrowers with a trusted venue to help them navigate student loans and prepare for success, financial success, that is, beyond repayment. Before we get into the questions, I must tell you that Office Hours is presented for informational purposes only. Nothing that you hear tonight should be construed as financial or legal advice. I do my best to give you the most up-to-date and accurate information from reliable sources, but ultimately, borrowers are responsible for making decisions about their student loans and personal finances in general. So I hope you will consider the center as a reliable source, and you'll incorporate the information that you hear when you are making decisions. But just remember, it's all about your personal finances. In the case of student loans, your portfolio, the benefits that you have access to. There's a large mix of things that go into helping you make the most informed decision, and we are happy that we can be a part of that mix. So without further ado, let's get into the questions. The first question that came through this evening was about graduate school debt. We had a question come through our contact form on the website that says, I have a huge amount of debt from graduate school and was wondering if there are more ways to help me repay them. So when it comes to loan repayment, there are many ways that you can get to that zero balance. So I wanted to walk you through first what makes graduate school debt different from undergraduate debt. And then we'll walk through how to select a repayment strategy in 4 steps. So the first thing is that graduate school debt starts off as more expensive because there is no interest subsidy for graduate and professional students. That means that interest starts to accrue on graduate professional student loans the day that they are dispersed. Now, right now, we are still considered as being a part of the national emergency due to the COVID-19 pandemic. So we're in what's called the CARES Act forbearance, and people who are in school, whether it's undergraduate or graduate school, and have taken out federal student loans, have been able to have the interest accrual paused so that interest is not accumulating while they are in school. But under normal circumstances with graduate school professional school loans, there is no interest subsidy. So the moment that disbursement hits the student's account, interest begins to accrue. And that means that the entire time that they're in school, interest is continuing to grow on that original principal balance. The other difference between undergraduate and graduate school debt is the introduction of what's called a PLUS loan, and those are loans for graduate and professional students. There's also another variety that's available to parents. PLUS loans have higher interest rates and also have higher origination fees. So this is another way that graduate and professional school student loans are more expensive than the loans that are borrowed during the undergraduate experience. Now, given that background about graduate school debt, the way that you approach the debt, the way that I recommend you approach the debt is the same, whether you're graduating from an undergraduate program or a graduate professional school program. And that's choosing your repayment strategy in 4 steps. So we're going to walk through those 4 steps. The first one is to know your loans. The second one is to locate applicable benefits. The third one is to set your goal for repayment. And fourth and finally, to choose your repayment plan. So let's walk through the first step. And that's to know your loan. So in order to put together a strategy that's effective and all-encompassing, you have to know all the loans that you have. When it comes to student loans, the main varieties are federal loans and private loans. If you're looking for your federal loans, there's one place to go, and that's studentaid.gov. You can log in there anytime for free and take a look at all of your federal student loan history, any loans that you've taken, regardless of the institution that you borrowed those loans, that you were attending when you borrowed those loans. So any balance that you see within studentaid.gov, that debt would be considered a federal student loan. If you have private student loans, you would not be able to see them listed on studentaid.gov. You'd have to visit each lender to find the information about those individual private loans. And if you're looking for a snapshot of all of your loans, both federal and private, then your credit report should contain that information. Now, when it comes to estimating payments for federal student loans, you can visit studentaid.gov. You can log in and use a tool that they have called the loan simulator. The loan simulator will allow you to estimate what repayment would look like based on your specific loans, as well as your household financial circumstances if you choose to go the income-driven route. So to view all of your options, you want to log into studentaid.gov and take a look at that loan simulator. When it comes to private loans, the options are controlled by the lender. So you'd want to contact the lender for options, set up an online account with them, log in and see what your repayment options are. And most people have federal student loan debt, so the bulk of the content that I share is focused on the repayment of federal student loans. So let's take a look at some of the benefits that come along with federal student loans. Now, this person reached out about just coming out of graduate school. And for people who are just coming out of school and have taken federal student loans, we know that their loans are direct loans. They're not FFELP loans because that program doesn't exist anymore for is not currently issuing loans. So direct loans would be the loans that we're referring to tonight. But just in case you're listening and you are a graduate professional school borrower, you might have some other types of loans, and I'd like for you to know what benefits your loans might be eligible for. So first, commercially held FFELP loans. These are an older type of federal student loans that are actually held by commercial banks. So their access to benefits is limited. So for the three main programs, benefit programs that are out there and being talked about right now, you'll notice that eligibility is definitely restricted for people who have commercially held FFELP loans. For the Biden-Harris Student Debt Relief Plan that's offering up to $20,000 worth of cancellation for eligible federal student loan borrowers, commercially held FFELP loans are left out of that plan. There was an option for them to be included when the plan was first announced, but that option was eliminated on September 29th of last year. There are a couple of other benefits, including the income-driven repayment adjustment and public service loan forgiveness. Commercially held FFELP loans, as they are not eligible for either of those benefits, but they can be consolidated into the direct loan program to gain eligibility for both of those benefits. There's another variety of FFELP loans called federally held FFELP loans. These are older federal student loans that are actually held by the Department of Education. And since they're held by the Department of Education, there's more eligibility for federal benefits there. They are eligible for relief under the Biden-Harris Student Debt Relief Plan, as well as the IDR Adjustment, and they can gain eligibility for public service loan forgiveness if they're consolidated into the direct loan program. Direct is obviously the way to go when it comes to benefits, because you look at that row and you'll see the answer is yes, yes, yes. Direct loans are eligible for all of these federal student loan benefits. And if the person happens to have private or alternative loans, unfortunately, these loans are not eligible for any of the benefits that are listed here, because these benefits are reserved for federal student loan borrowers. So if you're a recent graduate and you have federal student loans, then those loans should be direct loans. There's an asterisk next to the yes in the column for public service loan forgiveness and direct loans, and that has to do with parent plus borrowers. We'll talk about the parent plus borrowing situation in a bit more detail just in a few slides. But if you are coming out of graduate school, you borrow loans for yourself, those loans are direct, and they are eligible for a variety of federal student loan benefits. In addition to the larger benefits that are in the news lately, there are other benefits available to federal student loan borrowers. Some of them are based on your career, but I like to think of this as kind of like put this into buckets. When you're thinking about benefits, I'd look to the government first. The government has levels, so you can look at the federal government. You can also look at state government. In some cases, your county or your city might have some benefits that are available for student loan borrowers as well. If you're starting with the federal government, there is the IDR adjustment that's going on right now. There's public service loan forgiveness. If you're a teacher in a certain type of school, there's teacher loan forgiveness. There's also borrower defense to repayment, or opportunities to have your debt canceled in the event that you are designated as totally and permanently disabled. But there are many benefits available at the federal level. You'd want to visit studentaid.gov to read up on those benefits and find out if any of them apply to you. At the state level, I just wanted to share an example for the state of Maryland. The state actually has a student loan debt relief tax credit that's available each year, and that credit has provided most borrowers that I know between about $900 and $1,200 worth of a refundable tax credit that is supposed to be used to make payments toward their student loan debt. The cycle to apply for that tax credit is not open. It will open up this summer, but that's something that happens every year, and it's a benefit for Maryland taxpayers. If you are interested in more state benefits for student loan borrowers, I would encourage you to visit MHEC. That's the Maryland Higher Education Commission, Visit them online and you can see the variety of benefit plans that are available to Marylanders. In addition to federal government and state government, there are also some service-based programs that may provide a chunk of student loan repayment assistance for you based on your service with organizations such as the military or the National Health Service Corps or the Peace Corps. There are others out there, and you can find information about those on the organizational websites, but also through the state of Maryland at the Maryland Higher Education Commission. Finally, reach out to your employer. As more people with student loans enter the workforce, many employers are starting to update their benefits packages to include benefits that are specific to student loan borrowers. So I would definitely reach out to Human Resources or check out the benefits webpage for your employer and see if there are benefits available and whether you are able to take advantage of them. So you want to know your loans first, and second, take stock of any applicable benefits that might be available to you as a student loan borrower. Step number 3 is to set your goal for repayment. And I like to think of this in 3 categories. I call them fast, forgiven, or forever. Now, forgiven, of course, sounds best because we want to get rid of that debt and pay the least amount possible, but there are some restrictions that come along with that. So I just want to, for each of these different buckets, fast, forgiven, or forever, share with you some of the benefits as well as some things that you should be mindful of if you choose either of these strategies. So the first strategy, let's go with fast. Fast is for people who don't really like to have debt lingering. They want to get rid of it as quickly as possible. The benefit of tackling debt as quickly as possible is that you can leave less time for interest to accrue. And when you're able to attack the principal balance as early as possible, you can save money over time. And that leads you to quite possibly paying the least amount overall for your debt. But paying the least amount overall often means that you're going to pay the most upfront or pay the highest monthly payments so that you can tackle the debt as quickly as possible. And for many people, paying the highest monthly payment that's available through one of the federal student loan repayment plans just isn't realistic. But for those that do have the money and want to get rid of the debt as quickly as possible, then the fast route would allow them to achieve that by paying the highest monthly payment. And if they have extra money available, they can throw that at it as well because there's no prepayment penalty for federal student loans. So let's skip forgiven for now and go to the other extreme, which is forever. The benefit of paying forever, if you look at this as a benefit, would be that you could pay the lowest monthly payment each month because you're stretching out the repayment term for as long as possible. With student loans, you can get repayment terms that are up to 25 or sometimes 30 years. So if you stretch that repayment term over a long period of time, that drives down the amount of money that you'd have to pay each month. So in the short term, it can free up cash for other things because you're making the lowest possible payment. But on the flip side, you have to be mindful that when you make the minimum payment or the lowest possible payment each month, you're leaving a greater balance for interest to accrue. And as that interest accrues over time, the debt becomes more and more expensive. So on a month-to-month basis, maybe it's making things easier for you because it's freeing cash up for other things. But over time, the balance is growing, and you should be mindful of the fact that that balance is growing, and that could cause you to pay the greatest amount overall by taking so long to repay that debt. Now, somewhere between fast and forever, we find forgiven. The benefit of forgiveness is that you can pay some of the debt and have the rest forgiven or canceled. But in some cases, there are drawbacks, or potential drawbacks, I should say, to that forgiveness. And I'm speaking specifically about the Public Service Loan Forgiveness Program here. With public service loan forgiveness, in order to get that benefit after 10 years of working and making payments, you have to work for a specific type of employer. The realm is still pretty large. It's government, that could be federal, state, local, tribal, 501c3 nonprofit organizations, but just staying in the realm of public service. But some people might want to go for profit. If you go for profit, the payments that you make during that time will not count toward public service loan forgiveness. So if you're very serious about PSLF, know that there's a 10-year commitment. And even though you don't have to stay with the same organization for the entire 10 years, you have to stay in the realm of public service for the entire 10 years in order to get credit toward public service loan forgiveness. So some people might view that as a drawback because you're temporarily restricted to working for certain types of organizations. Also, with public service loan forgiveness and any other federal student loan forgiveness program, these are programs from the government, and the government can change. With PSLF, there could be a change to federal law. It doesn't seem to be something that's getting any traction. People have talked about it for years and nothing has happened, but it is a possibility. There could be changes. And also there are potential tax implications. At the federal level, public service loan forgiveness provides tax-free cancellation of debt, but some states might tax loan forgiveness. So there could be potential tax implications there. But PSLF is not the only program that offers loan forgiveness or cancellation. There's also the income-driven repayment plans, and we'll talk a bit more about those in the forthcoming slides. But with forgiveness, the biggest thing I think people need to be mindful of is that you're taking a chance, and it's not something that happens overnight. So it's very important for you to understand the major rules of the programs that you're seeking a cancellation or forgiveness from, so that you can be mindful to make sure that you're taking the steps to stay on track for forgiveness or cancellation through any of those programs. But these are the three buckets: fast, forgiven, or forever. And it's up to you to choose which goal is most feasible and fitting for you and your personal finances. So once you set your goal, the fourth step is to choose your repayment plan. And when it comes to federal student loan debt, there are several options, but they fall into two major buckets: the balance-driven bucket and the income-driven bucket. When it comes to balance-driven plans, these are the plans that are going to provide you with a monthly payment that's based on how much money you borrowed. There's no consideration for how much you earn, how many people are in your household. It's just about what you borrowed, and you can choose how long, between usually 10 or 25 years, you want to take to repay that debt. Then you have the income-driven plans. With income-driven plans, the monthly payment is calculated based on your household circumstances, particularly your adjusted gross income, your tax filing status, and the number of people in your household. So you have to think about which of those systems you'd rather pay your loans with: something that's fixed and based on the balance, or something that could fluctuate with your personal finances from year to year. So if you look at this chart here, these figures were pulled from the studentaid.gov loan simulator not too long ago. And in this example, I have a person named Chris who's borrowed $75,000 in student loan debt. These are all federal student loans, and has an adjusted gross income of approximately $55,000. Chris's payment options range from $288 to $807 per month. And this is in the first year of repayment. So the options range from $288 to $807. I had to say that again because that's a huge range from, roughly $300 to $800. So just another point to show that as a federal student loan borrower, you have choices. You definitely have options, and it's important for you to explore these options before you enter repayment. So let's walk through the balance-driven plans first. Looking at this chart, the balance-driven plans are the first four on the list: the standard plan, the graduated plan, the extended plan, and the extended graduated plan. So with the standard and the extended plans, these are plans that have fixed monthly payments. So the monthly payment amount never changes. The only difference between the standard plan and the extended plan is the amount of time that you want to take to repay the debt. If you go with the standard plan, that means you're looking to repay the debt in 10 years. That's the fastest plan that's available on this list. If you choose to go with an extended option, you're going from 10 years to 25 years. So let's look at what that means in terms of the monthly payment and the total amount to be repaid overall. For the standard plan, in this situation, Chris would have a monthly payment of $807. So if Chris makes that payment of $807 per month, every month on time in full as promised, then that debt would be paid off in 10 years. And the overall amount to be repaid would be $96,874. Now, if Chris decided, 10 years is a little bit aggressive, I think I'm going to go with the extended plan, you'll notice that the monthly payment amount drops. And it drops significantly from $807 to $452. The reason being is that instead of having 10 years to repay the debt, Chris now has 25 years to repay the debt. So taking that extra 15 years to pay the debt means that the monthly payment can be much lower. But look what happens to the total amount to be repaid. If Chris takes that extended plan at $452 per month and takes the full 25 years to repay that debt, then overall, Chris will have repaid more than $135,000. So that's about $60,000 worth of interest that Chris will pay if Chris decides that they would like to take the 25-year plan and pay at $452 per month. So right there, you can see the difference that it makes when you take a repayment term and extend it out as long as you possibly can. So that takes care of the truly fixed plans. The other two plans are the graduated plan and the extended graduated plan. The graduated plan is another 10-year plan. The extended graduated plan is a 25-year plan. But the graduated plan is a plan that starts you low and ends high. So in the first 2 years, Chris could expect a monthly payment of $458. And every 2 years, the payment would rise, kind of like stair steps. By the final year of repayment, Chris would be expected to pay $1,373 per month if Chris decided to go with that graduated plan. So the first 2 years, the payment will be $458. By year number 10, the payment would be $1,373. But if Chris stuck to this plan, made the payments as promised for 10 years, the balance would be gone after 10 years, and Chris will have repaid a total of $102,466. Now, when you look at the extended graduated plan, this is the one that for many people, when they see the monthly payment, they say, you know what, that's attractive because it's low. But I really want you to pay attention to how that lower monthly payment affects the total amount to be repaid overall. So with the extended graduated plan, Chris would start at $329 per month. And then every 2 years, that payment would rise and rise and rise until the final year. In that 25th year, Chris could expect to pay $722 per month. After 25 years of payments, the balance is zero, and it's estimated that Chris will have paid $148,061. If we look at that original principal of $75,000, taking this 25-year option with the extended graduated plan means that Chris will have basically repaid 2 times what they originally borrowed. So the extended graduated plan of all these options is the most expensive option over time. It is one of the most affordable options on a month-to-month basis, but over time, this shows you how much extra money Chris would be paying toward interest. Now, I mentioned earlier that there's no prepayment penalty on federal student loans. So Chris decided, you know what? The standard 10-year plan at 807 is too high, but the extended, 452, that's going to cost me so much more in interest over time. Chris could enroll in the extended plan and be obligated to pay 452, but send extra each month. And there are options when you pay extra in your services portal. There should be options there for you to direct the extra funds towards specific loans if you want to, once repayment begins. So even if you sign up for one of the payment plans that has a really low payment, you can pay extra if you'd like to. And of course, paying extra would expedite the process of you paying off the debt. So that covers the balance-driven plans. Now I want to shift gears and go to the income-driven plans. I have two sets here. The first line says IDR/PAYE. That stands for income-based repayment and pay as you earn. The second line is ICR, which stands for income contingent repayment. So for IDR and pay as you earn, the formula is the results came up as the same on the loan simulator. They take a percentage of your disposable income based on your adjusted gross income, the number of people in your household, and your tax filing status. And that amount is believed to be available for you to make towards your student loan payment. So in Chris's situation, with an adjusted gross income of $55,000, and I entered Chris as single in the loan simulator, it's expected that Chris can afford to pay $288 per month toward their student loan debt. If Chris continues to pay on this income-driven repayment plan each year, they'll be required to answer those same questions about their household finances each year: adjusted gross income, tax filing status, and number of people in the household. The government will rerun the formula, and Chris will know their payment for the next 12 months. So with this plan, it's estimated that Chris would start with a monthly payment of $288 per year. And by the 20th year, Chris's payment would be expected to be $292. I say expected because a lot can happen in 20 years. And if Chris's income changes, family situation changes, that changes the results of the formula. So the only thing that I think Chris could really bank on at this point is $288, because that's the payment that we know comes from Chris's current adjusted gross income and household situation. So if Chris sticks to this plan, it's estimated that Chris will repay about $69,668 on the loans and have estimated forgiveness of $84,832. The reason for that forgiveness figure is that income-driven repayment plans have a provision for cancellation after a borrower has been in repayment for either 20 or 25 years, depending on the repayment plan that they're enrolled in. So for income-based repayment and pay as you earn, for someone who borrowed when Chris did, which is recently, that requirement is 20 years. So after 20 years, it's estimated that Chris would have about $84,000 forgiven. The last repayment plan option is income contingent repayment. Income contingent repayment is another one of the income-driven plans, but the formula is definitely less forgiving. You'll see that the payment is estimated to be $670 in Chris's first year. So if Chris sticks with income contingent repayment, based on the Department of Education's estimates, after 25 years, Chris will have repaid the debt completely, repaying just shy of $105,000 overall. So for Chris, if Chris is wondering what to do with repayment, these are the options that are available. It's important to follow those first three steps: know your loans, locate the applicable benefits, and set a repayment goal of fast, forgiven, forever, and let those three steps feed your decision about which repayment plan to choose. It is so important that you select a repayment plan, because traditionally, if you do not select a repayment plan before you enter repayment, your servicer enrolls you in the standard 10-year plan. The standard 10-year plan for many people is often the least affordable plan. And in this situation with Chris, you can see that the standard 10-year plan is the most expensive plan. So if Chris does not contact their servicer and let the servicer know which repayment plan Chris would like to enroll in, and Chris has to go to the standard plan, what happens if Chris can't make that payment? That just opens up the door for potentially falling into delinquency, or even worse, going into default on student loans, and that would be completely unnecessary. So please be proactive and choose your repayment plan for yourself, because if you don't, one will be selected for you, and it might not be one that's affordable. I know that was a lot of numbers, but Chris, or the person that sent this question in, Chris, the name changed, but this is about graduate student loan debt, and I just wanted to make sure that you had a clear view of the options that exist under the balance-driven plans as well as the income-driven plans, but also the benefits and potential drawbacks of paying super quickly on the fast route, taking a long time to repay, like forever, or taking that chance on the forgiveness or cancellation. Okay. All right, so enough numbers for now. Let's move on to the next question, which appears to be related to the question I just answered. This one says, can you explain the income-driven repayment options? I want to make sure I am on track to have my loans forgiven as quickly as they can be. Okay, so I just went through the income-driven repayment options, so I'm not going to go through that example again, but I do want to talk a bit about cancellation, because that seems to be where this borrower was going, trying to make sure that they're on the path to have the debt forgiven or canceled as quickly as possible. So when it comes to income-driven repayment plan, a lot of people don't know that income-driven repayment plans actually have a provision for cancellation built in. And that provision is regardless of whether you work in public service or whether you work at all. It's a part of the plans. And that cancellation is supposed to come after a borrower has made payments for 20 or 25 years, depending on the repayment plan that they're enrolled in. At the core, what makes income-driven repayment plans different from the balance-driven repayment plans is the fact that your personal household characteristics are taken into account when calculating the student loan payment for each month. So the monthly payments are based on your adjusted gross income, your household size, and tax filing status. You're also asked for your state of residency. So the chart that you see here has a list of the income-based repayment plans, as well as when cancellation is supposed to kick in for people who are enrolled in these plans. So first, we've got income-based repayment. There are two varieties of the income-based repayment plan. One is called IDR. The other is sometimes referred to as IBR for new borrowers. For new borrowers, those are borrowers who took out loans for the first time after July 1st, I believe it's after July 1st of 2014. For new borrowers, the cancellation is supposed to kick in after the borrower has been in repayment for 20 years. For others who may have borrowed before, the number of years required rises to 25 years. But either way, there is a cancellation provision after the borrower has been in repayment for either 20 or 25 years. With income contingent repayment, ICR, it's set at 25 years. With pay as you earn, cancellation is supposed to kick in after the borrower has been in repayment for 20 years. And with revised pay as you earn, it depends on the types of loans that you're repaying on the plan. So if all the loans that you're paying through the repay plan are undergraduate loans, then cancellation should occur after you have been in repayment for 20 years. If any of the loans are graduate professional school loans, then that period jumps up to 25 years. So we see right away that there's a difference between how undergraduate and graduate school loans are treated. But the bottom line is cancellation is supposed to happen for people who repay their federal student loans on these income-driven plans after either 20 or 25 years of repayment. Some additional considerations when it comes to the income-driven repayment plans. I just wanted to show you all a piece of the formula that's used to calculate some of those payment figures I showed you in some of the previous slides. Revised pay-as-you-earn and pay-as-you-earn are the ones that use right now the most generous formula for borrowers, and that is by taking no more than 10% of your discretionary income. There's a proposal on the table for a more affordable income-driven repayment plan to come that would take 5%. But right now, these are the plans that are available. Revised pay-as-you-earn and pay-as-you-earn take no more than 10% of your discretionary income. With income-based repayment, it's never more than 15% of your discretionary income. Income contingent repayment, this is the one that I call the least forgiving. This is the one that takes up to 20% of your discretionary income. And then on the right, you see loan forgiveness after either 20 or 25 years. But a couple of things to consider when it comes to selecting an income-driven repayment plan. If the loans are graduate professional, we saw before that kicks up the number of years that you're required to make payments to get access to that cancellation in the case of repay. So under that repay plan, if you have graduate professional loans, then the cancellation period would jump up to after 25 years. Also, if you decide to get married, certain repayment plans will allow you to keep your spouse's income separate and have it to not be considered as available to pay your student loans. While other plans, your spouse's income is basically going to be lumped in with yours and considered as available to repay your student loan debt. So the revised pay-as-you-earn plan is a plan that considers your spouse's income as available. It doesn't matter if you file your taxes separately or if you file jointly, your spousal income would be considered. Now, if you and your spouse have similar income and have similar levels of student loan debt, then having things put together wouldn't really be a big deal because you're both in similar places in terms of the income and the debt level. But in cases where there's one spouse who might have lower income and higher debt, the other spouse has higher income and no debt, then you can have a complicated situation because the person earning the lower income on paper, when it comes to calculating their payment, with that spousal income being made available, that means that their monthly student loan payment would become higher. And that's not always feasible. So just keep in mind when you're selecting these plans to think about different life changes, such as getting married, or on the flip side, separating or getting divorced, having children, changing from for-profit to not-for-profit or vice versa, employment, attending graduate school and taking out loans. All of these items can have an impact on your repayment options when it comes to these income-driven repayment plans. So there's a lot to think about. Selecting a repayment plan is a very personal decision that I think everyone should take an active role in making, especially because if you do not take an active role right now, the default plan that you would be directed to is the standard plan, which for many people just simply isn't feasible. It's not affordable. So please take an active role in selecting your repayment plan, follow the 4 steps, and go to studentaid.gov to look at that loan simulator and explore your options before repayment kicks in. All right, I'm going to take a quick pause just to see if I have any comments or questions on social media. And it looks like there are none at this point. So let's get back into the next question. All right. Question is, I am from Maryland, but attended undergrad out of state and covered tuition through Parent Plus loans. My parent will not be able to repay, so I will be financially responsible. And I would like advice on how to manage payments and monthly rate adjustments and repayment strategies. So this is a situation where the parent has borrowed Parent Plus loans and is technically responsible for those loans, but it sounds like the parent does not have a capacity to repay. So the student is going to have to take responsibility for making those payments. And this is something that it happens pretty often. So the person that sent this question didn't give any numbers, but I wanted to provide some numbers so that we could look at potential strategies for the student to repay the debt. So in this example, we're going to assume that the parent borrowed $50,000. earns $40,000 per year, filing as head of household with one dependent. So I went to studentaid.gov, used the loan simulator to come up with these options. So we have the balance-driven options, and then we have the income-driven option. Notice that in this case, there's only one income-driven option. There's only one income-driven option because there's only one income-driven repayment plan that's available to borrowers who take out Parent Plus loans. And that repayment is the Income Contingent Repayment Plan, ICR. That is the only plan that's available. And in order to get enrolled in that plan, the parent would have to consolidate their Parent Plus loans first. So let's take a look at the balance-driven plans. You'll notice the extended fixed plan and the consolidated standard plan are exactly the same. But with Parent Plus loans, when you use that simulator, you'll see the consolidation options there because you have to consolidate in order to get access to the income-driven repayment plan. If you don't want income-driven repayment, you would not have to consolidate, but they give you these options just so that you can see what's out there. So extended fixed consolidated standard, same repayment term as 25 years. The monthly payment would be $303 per month. The total to repaid is just $3 shy of $91,000. The extended graduated plan and consolidated graduated plans, for all practical purposes, they're the same. They're a 25-year plan. And since they're graduated plans, they start low and end high. So in the first couple of years, the extended graduated plan would have a monthly payment of $223. And by the 25th year, that payment will have risen to $482. If you take a look at the total to be repaid, we're at $99,386. So if the student decides that they're going to repay the debt on this extended graduated plan, then they'll end up paying about double what was originally borrowed. Now, the income contingent repayment option that's there is estimated that the first payment would start out at $362 per month. And by the end, that 25th year, the payment would be expected to be $319 per month. It's important to note here that even though the student would be the one taking responsibility for making the monthly payments, the parent is still considered the borrower. So the parent's name is still on the loan. From a lending perspective and like a credit for credit reporting purposes, the parent is responsible for this loan. So it's the parent's income that is used to calculate this payment. And based on the parent's income and tax filing status and family size, for that first year, the payment is estimated to be $362 per month. Since the parent is on paper the responsible party, that's why the parent's finances are included in calculating the payment. But it's the student who has to look at these plans and decide which one is most feasible for them. Also, because the parent is responsible for the debt, the student would need to make sure that the parent goes through with the process of submitting the documentation to get enrolled into the income contingent repayment plan. So with Parent Plus loans, there are balance-driven options. There is one income-driven option. And since the student is the person who's going to assume responsibility for repaying this particular debt, these are the choices that the student would have here. And again, access to that income contingent repayment plan would really depend on the parent following through with consolidating the debt and also enrolling in the income-driven repayment plan and providing that documentation every year so the payment recalculates. So it can get tricky because one person is responsible on paper, but in real life, another person is responsible for paying that debt. It's something that you're going to have to work through with your parent to make sure that the debt gets paid, and hopefully it can get paid in a manner that keeps everyone's credit intact. And also for the student, I'm just hopeful that, with repaying this debt and repaying the debt for any student loans you might have taken out in your name, that you're able to come up with something that's feasible so that you still have, money to meet your other obligations, okay? So I want to go back to people who are on the front end of this decision about whether to borrow Parent Plus loans for their child or have the child take out a private loan. So I just wanted to show you this quick table with some differences between Parent Plus loans and private loans, because I've had some people who have told me that they were told not to take Parent Plus loans, but to take private loans instead. So I just want to show you some key points about Parent Plus loans versus private loans. For Parent Plus loans are not private loans. Parent Plus loans are federal student loans that the government lends to parents of students who are pursuing higher education. The borrower is the parent. Even though the loan is taken out for the child's education, the borrower is the responsible party on paper. They have taken out this loan to pay for their child's education. As for the interest rates and the terms, they're the same for all borrowers. The interest rates are the same. The application process is the same. Any opportunities for deferment, forbearance, cancellation benefits, all of that's the same across the board. And of course, since Parent Plus loans are federal student loans, they do have access to many federal student loan benefits. On the other side, we have private loans. Private loans are not issued by the government. Private loans are issued by banks or alternative lenders, such as credit unions. With private loans, usually the student will take out a private loan, but since the lenders are private banks, they usually require some proof of income, capacity to repay, as well as credit worthiness. And so the students are usually required to have a cosigner take a joint responsibility for that loan with them. But the student is the primary borrower for that private loan. The interest rates and terms may vary according to your income and credit worthiness. And since private loans are issued by banks or alternative lenders, they do not have access to federal student loan benefits. So if you were a parent and you're thinking about how to cover that gap for your child's education, there are a few questions that I think you should consider. The first one is, who do you want to be responsible for the loan? If you are comfortable assuming personal responsibility for the loan, then a Parent Plus loan would likely be your best option. If you want the student to be responsible for the loan, then the Parent Plus loan would not be the way to go, because you would be the person on a promissory note for a Parent Plus loan. The second question is, do you have the capacity to repay the loan? If you don't have the capacity to repay the loan, then it's probably not a good idea to take out the loan, because you don't want to sign yourself up for an obligation that you know you cannot meet. I will say that if your income is limited, though, the Parent Plus loan would probably be easier for you to obtain, because when it comes to Parent Plus loans, they're not evaluating your capacity to repay. They will evaluate your credit history, not your score necessarily, but they'll look at your credit history to see if you have any major, what they call adverse history items out there. But your capacity to repay in terms of your income level is not evaluated with the Parent Plus loan. And Parent Plus loans can be consolidated to gain access to the income contingent repayment plan. So if your income is low, you can have a low monthly payment once you enroll in the income contingent repayment plan. So if capacity to repay the loan is an issue, then the Parent Plus loan is probably better for you than the private student loan would be. And also, how is your credit? With Parent Plus loans, everyone is treated the same. It's not about your credit score or your income, but your credit history is examined for major events. When it comes to private loans, they're going to ask you about your capacity to repay, probably your income, your assets, and your credit. So I think the Parent Plus loan is probably a friendlier option for people who've had some credit challenges. But these are just things that you should consider as you ponder this decision about whether to borrow for your child's education or whether to have your child take out a private loan. This is a very personal decision to make. A lot of factors go into it. If you have questions about this process, I'd encourage you to reach out to us at mccfw.org/contact and fill out the contact form so that we can reach back out to you. And if you're comfortable, set up a one-on-one advising session for free so we can review your options before you get to a place where you have these loans and you're trying to figure out how to repay them. Again, that's mccfw.org/contact. All right. Next question. I graduated years ago. I'm curious if I can get assistance in having some debt removed or reimbursed. So this message came in from a longtime federal student loan borrower who is wondering about how to get rid of the debt by way of cancellation, or I would guess refund. For people who have been in repayment for quite some time, those who've been in repayment for near or at least 20 years or 25 years, the IDR adjustment is the pathway to cancellation that I think you should be paying attention to right now. The IDR adjustment is a one-time benefit that the Department of Education is currently working through, where they're going to look at everyone's history, everyone who has direct and federally held FFEL loans. The Department of Education is going to look at your history to see how many months you've been in repayment. And they're going to let you know this summer whether your obligation is for 20 or 25 years and how close you are to meeting that obligation. So for people who have already met the obligation of 20 or 25 years, this spring, we've been told that these people should start to see their loans canceled automatically, regardless of whether they were enrolled in an income-driven repayment plan previously. So if you've been in repayment for 25 or more years, I would encourage you this spring, check your account, be on the lookout for the mail. You might find the cancellation comes without you having to do a thing. For other borrowers this summer, we're expected to see our accounts updated with a payment count to let us know where we stand relative to that 20 or 25 year obligation. Now, for people who have commercially held loans, commercially managed federal student loans, this could be FFELP loans, Perkins loans, HEAL program loans, or other non-direct loans. In order for you to get the greatest benefit from this IDR adjustment, you need to consolidate your loans and apply to consolidate by May 1st of 2023. And if you're in default, you can also get out of default through the Fresh Start Initiative, and please try to do so before July 2023 so that you can take advantage of this IDR adjustment as well. But for people, like I said, if you've been in repayment for a long time, if you took out student loans and you've been in repayment since 2000 or prior to that, then there's a chance that your debt could be forgiven automatically, or you're just a couple of years away from getting to that cancellation by way of the IDR adjustment. There's some people who will need to take action. It's important to take that action by May 1st of 2023, but I really want to stress how much credit you can get toward this IDR adjustment. For many of these benefits, previously they require people to have been in repayment, making payments on the right kind of repayment plan, on the right kinds of loans for 20 or 25 years straight. And for a lot of people, that's just not how life works. So the Department of Education is conducting this one-time count to look over this history for everyone who has direct and federally held, federally managed student loans. And they're giving us that count, but they're going to give credit for months that would not have necessarily counted before. And here are the rules. You'll be given credit toward IDR cancellation for any months in which you were in a repayment status, regardless of the payments made, the loan type, or the repayment plan. So that means that you didn't have to make a payment for that month to be considered as a month that counts towards your repayment. If you made a late payment, if your payment was a few dollars short, if you were in the wrong repayment plan, it doesn't matter. Those months count toward IDR forgiveness. Next, if you're a person who's had lengthy forbearances, and this has happened to a lot of people, I met someone last month who had 11 straight years of a forbearance. That is not supposed to happen. No one is supposed to have more than 36 cumulative months of forbearance over the life of any federal student loan. And we're seeing people out here with 10 and 11 years. So the Department of Education is giving people credit for certain types of forbearances. If you had a forbearance that was 12 or more consecutive months, or 36 or more cumulative months, then you'll be given credit for all of those months. That credit will be given towards cancellation by way of IDR as well as PSLF if you work for a qualifying employer. Additionally, any month spent in deferment except for in-school deferment, any month spent in deferment prior to 2013 will count. And if you consolidated your loans, you will still get credit for your periods in repayment prior to the consolidation. That's why it's so important for people who have commercially held FFELP loans. If they're interested in cancellation by way of IDR, they would have to consolidate. Consolidating under normal circumstances would mean that your past repayment history does not matter. It doesn't count. But through this IDR adjustment, they're allowing people to consolidate, but also have that repayment history from the previous loans counted towards the IDR forgiveness. So if you've been in repayment, for 20 years or so, or even close to 20 years, but you have those older commercially held FFELP loans, you might want to consider consolidating to get on track for IDR forgiveness. The decision to consolidate can be a complicated one depending on your earnings and how much you owe, so don't rush into it. And again, if you'd like a one-on-one review, please reach out, mccfw.org/contact, and we can have an appointment, look over your loans, and help you work through the decision of whether to consolidate to get in the pipeline for forgiveness through this IDR adjustment. And for people who work for qualifying employers, this IDR adjustment basically extended a lot of the provisions that were included in the limited PSLF waiver, and it's basically extended them until May 1st of 2023. The only group that's left out of this extension is really retirees. For a retiree, if they apply during the limited PSLF waiver period, they would not have to still be working for a qualifying employer to get that benefit of public service loan forgiveness. But that piece of the waiver has not continued. The other pieces have. So if you are still working in qualifying employment and you did not get your PSLF application in by October 31st, please get it in by May 1st of 2023. So that you can make sure that you are getting the full benefit of this IDR adjustment and getting the maximum amount of months credited toward the 120 monthly payments you need to have all of your debt canceled by way of PSLF. Now, I talked for a really, really long time. We are almost out of time. Those are all the questions that came in ahead of this evening's edition of Office Hours. If you have any questions, I have a couple of minutes left. Please do drop them in the chat. I'm going to take a look at social media and see if I have any questions there. And I think I have one. Okay. This question is from someone who is having difficulty applying for public service loan forgiveness. The EIN for the organization, it's a religious organization that she works for. It does not appear on the PSLF online form. So the EIN doesn't appear on the PSLF help tool, and on the printed form, none of the employer categories listed are appropriate for the organization. What does the organization need to do to get their EIN to appear on the PSLF online form? Or which employer category should this former student choose to describe where they work? Okay, so this is about qualifying employment for the purposes of public service loan forgiveness. With public service loan forgiveness, qualifying employment means you worked for a government agency or a 501c3 tax-exempt organization or other organizations that provide qualifying services to the public. And there's a long list of the types of services that the organization would need to provide. In this case, the borrower's organization doesn't exactly fit into those categories. So I have a couple of questions. My first piece of advice would be to see if the organization has obtained the 501c3 designation from the IRS, because If the organization is indeed a 501c3 tax-exempt organization, that means that it should qualify for public service loan forgiveness, but it's possible that the organization just isn't showing up in the Department of Education's database of qualifying employers. So I would, one, find out if the organization has earned that 501c3 designation, and if it has, when you're using the online PSLF help tool, you can manually add an employer and you can add supporting documentation. So I would see if I could find a copy of that 501c3 determination letter. You could ask someone in the organization if they could provide it. If you don't know who to ask or they don't have it, there's a tool on the IRS's website called Select Check, and you can go there, search for organizations using their employer ID number. And if the organization is a 501c3 tax-exempt organization, you should be able to see their 501c3 determination letter online. You can get a copy there. So if you're able to get that 501c3 designation letter, upload that into the PSLF help tool as your supporting documentation and proceed with submitting your application for PSLF. Once you submit that documentation, basically you are paving the way. You're making the case for your employer to be included in the Department of Education's database of qualifying employers for PSLF. So if you're able to make an adequate case, and the Department of Education goes ahead and adds your employer to the database, that means that everyone behind you who works for that organization will not have to go through that extra step because you made the case and have proven that your employer indeed qualifies for PSLF. Now, if the organization does not have that 501c3 determination letter, which is a strong possibility because this is a place of worship, a religious organization, the IRS often allows organizations like churches to be treated as if they have that tax exempt status, even if they haven't officially applied for and been designated with that 501c3 tax exempt status. So if the organization is a religious organization that has not applied for and received that 501c3 designation, you still need some supporting documentation to make the case since the employer is not coming up in the database. So I would look to the, I would look for the organization's articles of incorporation to see if within those articles of incorporation, the organization was established for nonprofit purposes or religious or charitable purposes. And if that language is in there, I would include the articles of incorporation in my supporting documentation. I would include documentation of the work that the organization does in the community, any services it provides to the public or even religious activities, and just provide as much relevant information as possible about the work you do, about the organization and the work that it does to make the case for it to be included in the Department of Education's database going forward. So that's an excellent question. If you're looking for those articles of incorporation, I would ask someone within the organization, or you might be able to find them by going to the states, like Division of Corporations. Whatever state that this organization was incorporated in, you can go there, look for the records and see what documentation you can find about how the organization was established. What purpose was it organized for? It's a lot of information. It might seem like it's overwhelming, but if your employer truly does qualify, it's worthwhile to make that case, not only for the borrower, but also for other employees of the organization who might be eligible for public service loan forgiveness. So, you check one more time for questions. All right. I don't see any, so hopefully I've answered all of your questions this evening. As always, I would like to thank you for joining me for this evening's edition of Office Hours. If you have any follow-up questions, please do visit us online at mccfw.org/contact. You can complete the contact form and a member of our team will reach out to you. We do offer individual advising for free. Thankfully, that time is covered by a couple of nonprofit organizations that we partner with, and we are able to walk through taking an inventory of your loans, assessing eligibility for benefits, and assisting you with completing applications to access those benefits if you are indeed eligible. So again, please do feel free to reach out at mccfw.org/contact. Again, thank you so much for joining me for office hours. We will be back in 2 weeks. Our next edition will actually be on February the 23rd, which is a Thursday evening. So I'm looking forward to us seeing you all again. Thank you so much for joining me, and take care in the meantime.